The broadcast is now starting. All attendees are in listen-only mode.
Hello, hello. Hi, everyone. Can you guys hear me well? So I've got Rene on board. Yeah, well, thanks a lot for the enthusiastic welcome, Rene. Okay, so audio seems to be fine. Can you confirm that you see my full screen on your screens? Because I'm having a bit of issues with my manager. All good. Well, thanks, Rene. You're doing half the homework. Okay, so since it's 4 o'clock, I don't want to be delaying things. So I suggest we get going. I'm just going to push the recording button, which I think is now good. So thank you so much for making your time available to be with us today. The subject today is one where I want to do a bit of lobbying, because I fear that the German regulators have gone completely the wrong way about regulating things. Today, I'd like to explain to you what negative balance protection means and why I think that this is something that customers already enjoy, and why I also think that imposing this by law has been a pretty bad idea that I hope is not carried over to any other countries. If you have any questions, please keep them coming, and if they are relevant to the flow of the presentation, I will try to tackle there and then. If not, I have set apart quite a bit of time at the end of the webinar to go through a Q&A session. So first thing is, what is negative balance protection, NBP for short? What does it amount to in practice? And unfortunately, what does this mean for German customers? Because I think German customers are the big losers out of all this. And as I said, the Q&A at the end of things. Right, so let's get going. What happens if any of you guys wanted to buy a position in a stock on credit? Well, what you would do would be, say, put down enough equity to cover a portion of the position and convince somebody to lend you enough money so that you could buy more than you had equity in the whole thing, and of course amplify your P&L as you do so. So you borrow to increase your P&L on your equity, and this is what you would do on any normal exchange traded instrument, or off exchange traded instrument, like buying a mortgage. That's what you're doing. You're putting down some equity to buy a house, and you're financing some of that with debt that you will eventually pay down by either selling the underlying position or just amortizing the debt from your income. Right. So what does negative balance protection amount to in the setup of a CFD, or as per this regulation? Well, what it amounts to is a guarantee that no matter what happens to the value of the underlying position, the person has lent the debt will not be able to come after more than the equity that has been put down by the trader. So in this case, really, what negative balance protection amounts to is a put strike, which is expiry free in that sense that there's no maturity for it. And also, in a way, it implies that there's a zero premium that has to be included in the price of the CFD that is set in place by the provider. So this is, I guess, the core point of today's webinar. Does anybody disagree on what I'm saying just now? So it's basically a guarantee that no matter what the price of the underlying does, the amount of commitment by the trader is restricted to the equity that he has put down. Because were he to exceed, were the losses on as a result of selling the position to exceed the amount of debt, the lender would not be coming after the equity holder. Now, as an option, of course, the value of the put option is higher the more volatile the underlying, which is as you would expect. Also, more importantly, the closer to in the money the option was, which means the higher the leverage, the higher the proportion of debt, if we go back to the previous section. So the higher the proportion of debt to equity, the more value this put option has. And of course, the longer the time horizon, of course, because it's infinite, the higher the value. Now, this is all going against the person that has gifted this put option for free, which is what the negative balance protection amounts to. So it's kind of really going the completely opposite way of what one would want as a regulator or even as a provider. Now, and of course, the impact of all this really depends on whether who's providing this put option. In our case, as a broker, we are barred from taking market risk in our own right. So if we were to guarantee customers a negative balance protection, which is something we cannot do by the spirit of what we do, then our we would be exposed to market risk in the sense that if the value of the underlying we were offering, say if we had offered, say, trading on the S&P 500 with negative balance protection, then we would actually be long de facto the underlying, because of course if the underlying went short and we had to pay up, it's as if we had been long in it, which is something we cannot do as a broker. In order to hedge that risk away, we would have had to purchase an option in the market to fully hedge that opposite mirror of the negative balance protection that we had offered. So, and we would have to pay for the market value of that option, and that market value would be quite expensive, as we have discussed, and also differently expensive for different customers depending on the degree of leverage they had taken on. So it's kind of a really tough situation for us to be hedging. I've taken the conclusion away. So if we have to offer a negative balance protection on the DMA CFDs that we typically offer, because we have a commitment to only offering CFDs that are listed on a regulated market, then we cannot really do this without engaging in a market risk, which we cannot enter as per our regulatory license. This is different for dealers. A dealer, which would be somebody that's essentially a betting house, is free to, as long as they have enough muscle to honor the bets they enter into, to pretty much do whatever they want, especially as in this case, they would not have purchased the underlying asset to begin with. So a CFD by a dealer amounts to a bet between two parties where one party says, if it goes my way, I win, and if it goes your way, you win. And of course, because there's no underlying asset that has been purchased by the dealer, what the price of the underlying does is neither here nor there. The only thing that matters is once the customer is out of money, then the customer is out of money, and the dealer has kept the customer's money, and he doesn't really care what happens to the value of the underlying if it goes much further than what the zero for the customer was, because he hadn't purchased the house to begin with, or the house or the stock or whatever. So for a dealer, it's actually free to offer this put option, to gift this put option, because they have no physical exposure to be hedging if they're purely dealing. Of course, most so-called brokers are actually broker dealers or hybrid propositions, and some of the exposure they've got they don't hedge. Some of the exposure they do hedge. So the part they do hedge is the part by which they behave like a broker does, and in that case they would be liable for part of the position. So they would have to purchase part, but not all of the option. As you can see here, the bigger the leverage, and the more the higher the proportion of flow that the offerer is hedging in the market, then the more expensive it is to offer negative balance protection, which means unless a broker wants to actually stop becoming a broker and actually take on market risk in the market, we cannot really offer negative balance protection. I guess I'm repeating myself, but is the point coming across? Now, more importantly, and this is another one that has derivatives to it, is let's say for a second that we actually chose to so-called grant this negative balance protection. Well, what would happen if we did hedge the exposure and commit to reimbursing, to not going after our customer for any negative balances he had? Well, at that point, obviously what happens is there's a first tranche of risk, which is the trader equity that's at risk. Now, if for whatever reason there was a gap in the market that actually wiped out the entire trader equity, the next person guaranteeing this negative balance protection would be us, the broker. We would have to face with our own capital whatever losses in excess of the trader equity had been incurred. But more importantly, if that were not to be enough, then we would be in an FXCM or Alpari scenario where the customers who weren't taking any excess risk in, say, the Swiss franc, they and weren't in theory exposed to what happened there, they actually were, because all of a sudden some of the customers had blown up their own accounts, so much so that the entire broker equity was gone. The brokerage defaulted, and as a result of that, people who really had nothing to do with the trades were waiting for, I think it was like 2 years pretty much, for the money to be paid back, just because the money doesn't rain from heaven in the case of a broker. So to summarize, and I mean, I'm really doing this to, if you guys know the guy who has, or the German lady, I think, who has come up with this genius idea of imposing negative balance protection, here's the points that I would have made to her if she'd asked me. So the first point is that it has very limited impact in practice. So even if contractually, we, for instance, as a broker, cannot commit to not pursuing any debt, in other words, offering negative balance protection, well, in practice, there are different hindrances to recovering any bad debt. So one of it is like, hey, you don't want to alienate a customer who has already lost a lot of money and who may want to come back in the future. That's really a commercial reason. The other economic reason is, if you want to get the money back from the customer, then you will probably have to send a lawyer to chase his debts, and that implies that you'll have to pay for the lawyer, and that can only come out of the amount that you've recovered. Now, the amount that have been recovered may likely be small, because in many cases the customers will have lost a lot of money already as it is. So there was a loss that you were facing anyways, and at some point you really have to make a decision on what is the minimum amount you will need to pursue to even start pursuing the whole thing, which de facto means you already have negative balance protection unless you're trading with very high risk, in which case we would very likely reduce the leverage anyhow. So the other point, as we've seen, is because the treatment of the hedging is different according to whether a broker is a true broker that is bringing the liquidity to an organized market, or whether it is a dealer that's just listing a price, creating a bet off the back of the organized market, but not really hedging in the background. What this does is push everyone's liquidity away from organized markets. So all the guarantees that protect you from, say, stop hunting, spikes in prices and so on, that you do enjoy when all the liquidity converges in a single rule book, well, this measure has actually just driven it one step away from where it should be. Another point which I think is really tragic is that, imagine you're somebody thinking, you're a student, like a 20-year-old student that's thinking of starting to invest in stocks. You don't really have enough money to start investing in the cash market, because you can't really fraction the trades in the cash market. So you want to start with CFDs, which have many good things about them. One of them is that you can have fractional exposure to any asset that you want. You don't have to buy a full Amazon share for, say, $1,000. You can get $10 worth of Amazon share through a CFD. Imagine then you're welcomed with negative balance protection, reassuring you that all you can lose is all your money. I mean, what sort of image does that give in terms of getting people to think of this as investing? So what this is telling you is, okay, you can gamble with some sort of guarantee, but it's really turning CFDs into a completely gambling product, which is something it shouldn't necessarily be, because CFDs are actually born off the back of an unmet demand by retail investors. I mean, CFDs, it's not a coincidence that CFDs have been invented in the last, say, 10 years, where the internet came about. And that is because what has happened in the last 10 years is that the markets have been really democratized, in the sense that anyone, regardless of the amount he has to invest, has been wanting to invest, because he could get access to it through the internet. And the problem was, and remains, that organized markets haven't really put down the minimum trade sizes so that people can start with smaller market tickets. So you still have to have a full lot of a futures contract exposure is a huge amount, and unless you can't put down 10, 15, 20k to of an account to start trading, which a lot of people don't have until later in their lives, or certainly not for testing purposes, well, CFDs are actually the obvious option. So if I had been the German regulator, or had at least had the chance to speak to them before they did this, there really were two solutions to the underlying root cause that has been in the market. The root problem in the market is that there is a conflict of interest, in the sense that whenever people are dealing in the price of a CFD, i.e. not a DMA CFD, they actually stand to win customer losses. And the probability of their winning is higher the higher the leverage that the novice, inexperienced retail trader at the other end of the trade takes on. So this has resulted in lots of people, not least the dealers, but also the introducers that feed on business to them and get paid rebates for the volume that's done. Lots of people entice people who don't really know what they're doing to actually trade with lots of leverage that is really bad for you in the long run. So because of this conflict of interest, people end up blowing up their brains, and the retail trading industry is getting a terrible name, even though it shouldn't really, because all it does is democratize access to the market, provided, of course, things were done properly with a proper guarantee. So the one solution that I can think of is to go to existing exchanges and tell them to get their act together and split the nominals of exchange-traded titles to something which is much more manageable for everyone's wallet, because the technology already allows for this. I mean, there's no issue whatsoever. The percentage changes in the value of Amazon stock are going to be the exact same replica of the underlying value of Amazon, regardless of whether the stock is worth $1,000 of the nominal or say $5. And then there would be a marketplace for providers who would, on the one hand, realize that there's more commissions to be made by taking people to an exchange and lending them money to trade on credit, but also offsetting the risk of that credit being too much and people really risking too much, so that the provider were making a loss. That would converge on a level of leverage which was actually driven by the credit risk by the customer at the other end of the trade, and the market would gradually self-regulate itself. Now, because this is being allowed with to coexist with people trading off exchange in a betting market. Of course, in a betting market, there's no such credit risk as we've discussed. I mean, all the customer can lose is all his money, but the exposure is not hedged, and this conversion doesn't take place. The other alternative is if the existing monopolies are too kind of lazy to actually do their technological job and lower minimum contract sizes, the alternative would have been to force all CFDs onto a MiFID exchange place, like a multilateral trading facility. That's what MTF stands for, and force all trading to be crossed via an order book, just like it's done on, say, cash futures, cash stocks and organized futures markets. The benefits to that would be that all the liquidity would converge in a single order book, which would narrow the spreads. It would level the playing field in that everybody would be free to take, as now, but also make liquidity. So it would not be the privilege of, say, dealers to keep the losses by brainless people who are trading with too much leverage. You could make that too by entering the order book as a maker of liquidity. And last but not least, and this is the key to the whole thing, no one in his right mind, certainly not brokers, would have any incentive in pitching excess leverage to customers in order for those customers to blow their brains off. Because obviously the first one that's hurt when a customer blows his brains off is the customer himself, but the second one is the broker that waives the revenues once those guys stop trading. So the conflict of interest would be gone away, and that's, people would really start trying to educate, trying to tell people to do what's right for them in the long run, because it's a win-win for all parties when people stay in the game for long and learn to trade properly. So it was very, very, very easy to do this. Cash stocks and even futures went through these kind of teething issues when they were first invented, until people converged on the idea of an organized order book with a central counterparty. And it just defeats me that somebody as ignorant as the lady who has put this forward is allowed to actually hold a position of responsibility, because it's basically a case of not having done the proper homework, really. So with that in mind, that was essentially what I wanted to bring across in today's webinar. I hope it wasn't too heated a commentary, and I'd love to have your views on all this, but that's the long and the short of what negative balance protection means. It's really a fudge that's not solving any problem whatsoever, that is stigmatizing CFDs for good and has detracted from customer choice, because the most likely thing that will happen here is that that brokers will cease to offer CFDs in the German market. Of course, dealers will do it, but not brokers. Right. So there's a question from Lars here. So he's saying that this is obviously an impractical idea, and the question is obviously the BaFin has ruled this. Now there's a number of questions on the ruling, because that's another one. So BaFin talks about außerbörslich instruments. So this. My understanding of this, which we are now discussing with our compliance advisors, is that this does not affect any trading in FX. And does not affect any trading in CFDs that are traded on an exchange. Now, the CFDs we currently offer on indices are all listed on a MiFID regulated light exchange like LMAX, which means I do not think that we are affected by this prohibition, because if this prohibition were to be taken to stuff that's listed on exchange, it would have to be extended onto futures markets, which would amount to telling Eurex that it would have to not demand collateral for margin calls, which would basically take the whole futures industry down. So my understanding is that this does not affect us to the extent that we offer exchange listed MTFs, and also Forex, which is not affected by this regulation. However, going forward, if we do introduce trading of single stock CFDs, which we are planning to do, unfortunately, I think we will be forced to bar German customers from using that part of our offering. So that's the thing. Either way, Lars, the important thing is if anybody were to be fined on this, it would not be the end customer, it would be the provider. So you will not be affected by this one way or the other. And as for our part, as I said, we have been asking for legal opinions on this, and we are confident about the stance that I just mentioned. So there's another question here by Stefan. So Stefan's point is basically saying, well, let's say I have a very highly levered position, and there's a big gap in the market, such as when the Swissy event. Would Darwinex come after me? Well, it is very unlikely that we would. That is the long and the short of it. As a matter of fact, we have not to date prosecuted any of the negative balance amounts that we have had, but obviously we have to reserve the option of pursuing that. If only, and this is also just thinking of my own personal risk. So if I allowed Darwinex to enter into a contract where it could be defaulted by any single customer, and I guaranteed to that customer that he was not going to be prosecuted, that creates an amazingly large moral hazard for, say, competitors trying to take us down. That's the first one. And the second one is if Darwinex were to go belly up as a result of that, there would be a liquidator who would come in to seize all of Darwinex's assets and try to seize responsibilities for whatever had been done. And in that case, I personally would be very likely prosecuted with all my assets to make good on a promise which I shouldn't have been making. So that's kind of how bad this is. Okay, there's a point here. Yeah, so René is recommending that we read the LMAX's paper on last look and so on. I mean, I think the whole last look thing is one more element of this bringing stuff onto exchange. I mean, it's not like we're facing a problem that has come out of space and hasn't been tackled before. Both futures and stocks had the very same exact issues that we're facing right now in the CFD industry. It's just because it's a new industry that has been born off the back of the regulated markets, because regulated markets have been caught asleep at the wheel to cater to the new needs by smaller customers. All that's required here is to put the whole thing onto an exchange. It's as simple as that, and it just beats me why the regulators have not been able to do that. I mean, at least the German ones. I think that there must be a very strong lobby by dealers who have pushed this through onto somebody who's ignorant of the way to solve this, because otherwise it just, short of corruption, I can't think of why this is going like this. So Stefan is saying the problem perhaps is that other brokers will not act in a similar way. So now let's come back to the term brokers that I've mentioned before. So then I'll bring this slide up that discusses that. So there's pure brokers. A broker is an agency-only intermediary who has no skin in the game of their customers. So if it is a broker cannot have skin in the game of their customers, and offering negative balance protection is a roundabout way of having skin in the customer's game, and that's something that you cease to be a broker the moment you do that. So we cannot remain a broker and offer negative balance protection. Now, I am sure that if I was the CEO of, say a large broker dealer like, IG or CMC or whatever, I would be very happy in one way, in the sense that I could now, compete without, say, interactive brokers being a problem to me, because they are also part of the players that have been kicked out of this. I mean, I think that what this does do is kill DMA CFDs. So Stefan is saying regulators want to protect customers against such dealers. I mean, I would not call those guys brokers, because they're not brokers; they're actually dealers. I think the way for regulators to protect customers from being enticed into taking leverage is to remove the incentive for anyone to want to offer leverage to whoever doesn't know what he's doing. And the best way to do that is to bring the whole thing onto an exchange. It's really as simple as that. So Eric is asking whether France did introduce the same regulatory constraints as the German one, and the answer is no. France has introduced some constraints which have been to ban binaries. I think it's to ban advertising of leveraged products, but there's no obligation of offering negative balance protection, because, as I said, I think this is actually, I'm sure this could be sued in court and it would be taken down. So this does not apply to France. And it is the law Sapin too, so that's what it does. Okay, well, so if, I guess my appeal to you guys is, if you know anybody who's close to BaFin, it would be quite nice to bring forward these arguments, because I just refuse to believe that if somebody had brought this forward in the consultation phase, that they would have come back to this negative balance protection idea. Because amongst other things, what negative balance protection will do, it's like it's as if the problem was that customers were losing more than they had in their accounts. And the problem was that customers were losing all that they had in their accounts, and this is not going to make one single iota of difference. If anything, it will make it worse, because the kind of people who were trying to educate customers in not doing it will go away. So I think this is one of those clear examples where not only have you not made the situation better, you have actually positively made it worse. So as I said, I'm sure you can probably tell I'm a bit angry about this, but it sort of beats me. Okay, so unless there's any questions more Darwin Nexus specific away from the topic of the webinar, I think we've, I'm sure you're all longing to go to the beach for the Friday. So Rene is saying that unfortunately the German CFD Association is strongly backing this NVP stuff. Yeah, well, I suspect this is where it's coming from, and I think I've said it already. So those guys make their money from customers, from market making against customers. They do that away from a rule book that protects customer interest and guarantees that the price finding mechanism for the CFDs is as per some transparent rules that are meritocratic, in the sense that everybody can be a maker and a taker. And what this is doing is it's essentially preventing you from being a maker of liquidity. Because if you were allowed to, if CFDs were forced onto an exchange, you would be able to make markets against the losers and keep some of those profits yourself. So this is kind of discriminating against you guys, and of course the association of CFD providers wants that, because that's the unfair edge that they're now perpetuating. So it's as simple as that. But eventually things will happen somehow, one way or the other. In our case, I have strong faith that at some point we will be able to become one such market ourselves, and that our customers will learn to make liquidity against each other, just like customers of, say, Betfair learned to do it. So when Betfair was first invented, everybody was saying, "Oh, this will not take off because there are no liquidity providers, and the liquidity providers are essential to the functioning of a marketplace." But I see lots of very, very clever young guys out there who can learn to make markets. We allow people to crowd fund Darwins, which is another way of saying you could become a liquidity provider and crowd fund your liquidity fund through a Darwin, and that's eventually what we will be doing, hopefully not too far away in the future. So we'll get there. It's just, we'll have to bear with some of the hiccups along the way. But anyways, it's been a real pleasure to see all of you guys. If you have any suggestions for any upcoming webinars, feel free to email us at info@darwinx.com, and we will be very, very open to any suggestions. So take care, guys. A real pleasure. We will upload this onto YouTube now, and hopefully other people like it as well. Take care. Bye.